Hi, everyone. How are you? Glad to have you here today. I'm Jorge Sanchez, Manager of Physician on Fire. Today, we're going to have a webinar that I've been excited to host and curious to learn. And it's called How to Avoid Common Tax Mistakes. It's a topic dear to me and to my wallet. Today, we'll have Bill Martin. He's a CFA. He's the Chief Wealth Officer over at Earned. We also got Dave Harlow. He's a CPA, and he's the Senior Wealth and Tax Advisor over at Earned. Also, Earned is going to be a sponsor for our first ever Prosperity Conference next March. So look out for notices on that. We're excited to be seeing them. And without further ado, let's get started. So let's talk about what the numbers are, just the data on physicians. We're considered high-income earners. 91,000 is the average federal taxes paid by a physician in 2022, who, by the way, the category is married filing jointly. The average state taxes in 2022 was 14,000, of course, by physicians who were married filing jointly. And look at this, the median marginal tax rate of physicians is the second highest tax bracket at a painful 35%. So why is this webinar important? Because it's common mistakes. I've had the privilege of sitting across hundreds of cafeterias in the United States at hospitals and met with many doctors and many groups. And I see a lot of mistakes. One mistake I made was that I am an independent contractor. I'm a medical expert witness. So it's a side gig. So in that, I work as a 1099. Man, and in 2022, I probably made about 98,000. And I was working with 8 different firms, and they would send me the 1099 payment stubs, and I lost track of it. And I lost track of about $30,000, $35,000 in income. I didn't report it. My tax advisor, if I didn't give it to him, there was nothing he could do because I made the mistake. And man, and I moved from Arizona to Florida. So I left the state of Florida, and I got dinged with fees, and that 35 became like 45,000, 46,000 in with tax paid. So that was a painful lesson. So you got to be organized. The thing that physicians make is that we believe in do it yourself. And man, we're literally S corps and LLCs. When you're at that level and you make the amount of money that you make, you do need some help to have someone manage your data and just be organized. Another mistake I've seen doctors make is that they claim their office, their home office, but what they don't do is they don't document. Like, one fact is that your home office has to be used exclusively for your business if you're 1099. And what a lot of doctors do is they just claim a bedroom, and then when they get audited, they ask for pictures and they get caught, and then they get penalties on that. So again, understand what it's like to be a 1099 and really understand those levels. So that's pretty much it as far as common mistakes, but I know that there's a lot of other mistakes we can make.
Jorge, yeah, thank you for jumping in and being willing to be transparent. But I know this, I know Dave knows this too, of working with so many different doctors. Your experience, you're not like alone. This is very, very common. And that's why we've even phrased this way, common tax mistakes that doctors make. And we're going to run through a few of these. And probably even more importantly is how to best avoid them. Before kind of getting into the mistakes themselves, I just want to take a moment and share, what if of that 105,000 between federal and state on average that doctors are paying, what if you could trim that by $25,000 per year? That's a meaningful number, but what all of a sudden makes like a material impact on your net worth is looking this over time, over 10, 20, and 30 years. That's what this graph is showing. And it's assuming that you just don't take that $25,000 and spend it, but you're smart with it. You take this additional savings and use this to continue to multiply your net worth by investing it over time. And that $25,000 per year in 30 years ends up becoming an additional $3 million in your net worth. So yes, this is important, but I think putting it in this framework really sets the stage for what Dave and I are about to go through. So the very first mistake, it sounds elementary and basic, but yet it is so important. Jorge, you mentioned, doctors tend to do some things by themselves, and 46% of doctors do their own taxes. but yet that leaves more than half that are hiring CPA professionals, and tax accountants and others that are working on preparing their taxes. And doctors may think, I got a professional handling this, I'm in good hands. But what may not be known is that tax compliance, or the act of filing those taxes, is not the same as tax planning. And most of these accountants that are doing these taxes are being reactive. They're looking in a rearview mirror, pulling together what's already taken place and just making sure your filing is compliant. However, if you think of this, there's so many more opportunities if you can really take a planning-based approach. So from a proactive planning perspective, sometimes we get the question, when's the best time to start thinking about this? Well, the earlier, the better. But even where we sit right now, toward the end of the year, it's not too late. And so I think that's what's really important. A key takeaway from this is, even if you hadn't kind of engaged in proactive tax planning up to this point, it's really essential that you do this with the final few months in front of us, to be able to take advantage of things that you wouldn't necessarily be able to do once that clock rolls into 2025. Dave, as we were preparing, you'd mentioned, I got a couple stories I think I hear. If there's one that comes to mind, I would love to hear why this is such an important thing to understand.
No, absolutely. I appreciate it, Bill. It's interesting. You mentioned, before that clock rolls over into 2025, you said it already, the earlier, the better. One of the big problems we have, and I know a lot of our physicians are W-2 employees. If you wait until even October or November to kind of discuss and plan around the things you're doing, that very well may already be too late in some cases, because some of the changes you might need to make have to do with things you can run through your payroll. And if you've only got 2.5 months left out of the year, that might not be enough to make some of those changes and implement them. But anyway, one of the things I was thinking about this year specifically, I have a client. We have all kinds of clients, and there's a category of clients we call tax only. These are the clients who we don't kind of engage all year long with. They just kind of send in their stuff after the year's over and so forth. And I had a client who kind of misunderstood. He's got a defined benefit plan, which can allow you to make contributions of $200,000 plus. He misunderstood some of the rules around that and what he needed to do in terms of his payroll. And when we discussed it in September of the following year, unfortunately, he had been planning on this $200,000 deduction, and he wasn't able to take anything. It was a zero. Where he had planned on that. So it's about a $66,000 tax mistake, just because, there was no conversation beforehand. So anyway, that's kind of an extreme example, but there are things like that. Yes, there are hard cutoffs, year end, April 15th for funding certain things. But yeah, super important to be engaged early in a tax year for that tax year's planning.
Thanks, David. One other quick story. I know a colleague of ours had a chance to review, was working with a prospect. They had already engaged another CPA. And what we found in looking through this is just simply by doing some of the strategies that we're going to talk about in this particular webinar, there was $25,000 in that case of taxes that were kind of paid unnecessarily, even though they had engaged a CPA, kind of like you were saying, a tax-only situation, and not really taking the deeper dive into let's be proactive about that. So that number that we've talked about, you threw out 66,000 maybe in tax liability. Here's a 25,000, story that I just said. These are meaningful numbers, and I think it's really important to take away this very first thing that we started with is be proactive, plan, because that's going to be the best way to minimize these taxes.
Yeah, really.
Go ahead. Tax mistake number 2, but is there something you'd like to add in front of this? And I know you're taking this slide too.
Sure. Yeah, no, I was just gonna say, based on those 2 brief examples, the $25,000 a year, that might sound like a lot, and it is a lot. It's impactful, but in terms of tax mistakes, that's not a big number. I mean, that's very realistic to think that you could save that much by just doing some good tax planning. So anyway, not maximizing employer-sponsored retirement plan contributions. This is exciting. As healthcare professionals, you actually have more options than a lot of people do. A lot of people you'll hear about traditional 401k plans and so forth, possibly some employer matching. In a lot of cases, you'll be able to kind of double what an average person might be able to put away. You see, we've listed here 401k, 403b, 457. You can maximize what you put into a 403b and a 457 plan if that's offered by your employer. And again, depending on your employment situation, as you maximize these dollars, you're also going to maximize what your employer is going to match for you. And that's kind of the free money we're talking about, as you know, employers are generous, hopefully, and are willing to match. But in most cases, that requires you to put in what you're able to. So yeah, just make sure to, and you know, I always tell my clients that work for a hospital or a group or whatever, I say, listen, you need to talk to your HR, your payroll people. Just, you know, make sure that you know what all opportunities are there for you, because a lot of times we might just sign up for one or the other and not even know really what's available to us. Super important. And this slide is just kind of interesting. This kind of gives us an idea. Again, a lot of us are W-2 employees. Maybe we've got a side gig like Jorge talked about. Kind of this slide gives us a snapshot of some of the things that are available to us. The green pieces here, those are the parts that are available to you as an employee. Okay, those are employee contributions. All the stuff in gray, that's stuff that the employer would be putting in for you. Now, if you're in a physician, like a specialist physician group or something where we've got a lot of groups that actually have these cash balance plans set up where you're able to fund as much as $250,000 per year per participant. Now, that does come technically from the employer, the group, but it's kind of elective. Each member of that group is gonna do that for themselves. But anyway, very powerful. There are a lot of tax savings to be had through just these deferrals and things that you can do through you know, employer sponsored plans.
Yeah, and for me, Dave, the main takeaway here is what you said. You may think, oh, I'm maxing out one particular plan, a 403b plan, but there's probably a lot of other things that are available to at least consider and explore. Help not only defer taxes, but also grow that wealth over time. Let's move on to tax mistake number 3. This one may not be at the forefront of everyone's mind, but it's a really important consideration, especially with thinking of what we just talked about on the previous mistake. But it's concentrating your investments all in one account type. So as we've had opportunities to work with thousands of different doctors and look at their situations, what we've noticed is it's pretty common for the doctors to be investing in their retirement plan. Maybe they haven't fully maximized like we talked about on the previous sets of slides, but it's pretty common that we do see this. What happens though, if there's no other dollars that are being saved outside of those particular plans, it ends up creating a mistake. And why is that? Well, as you get closer to retirement, and we'll have some more slides that reference this more specifically, but you have a lot more limitation on what you can do to fund once you no longer have a paycheck. And it could create higher tax liabilities. You take required minimum distributions from these plans, and all of a sudden you're in a higher tax bracket, but you're not earning income to do this. There's creative ways and smart ways to do it, and tax diversification is that concept. And so here, what this is just representing, this pie chart, is if you can think about your wealth, how do you build this financial net worth across these different buckets? It does give you a lot more control, like I was referencing, when you get to that retirement phase. And in some cases, we've seen both the longevity of your assets is extended, and the amount of income that you can withdraw is increased when you take this kind of approach. So I think it's just a good one to earmark, to think about. Yes, I'm socking away money in my retirement account, but are you doing things in tax-free? We'll get to that in a minute, but like the Roth accounts, to where you have that bucket filled up. And then your personal, like, brokerage and investment accounts. It's another really important concept. Dave, I'm going to hand this to you. Tax mistake number 4.
Sure. Not writing off business expenses. Can you believe it? Can you believe some people don't think to write off business expenses? Usually it's the other way around. Doctors come in and they say, can I write off this? Can't I write off that? I should be writing off this, right? It's like, that's at the forefront of their mind. What can I write off? And they want to write off everything. So this mistake kind of can go both ways, right? You kind of like Jorge talked about the home office, right? You don't want to go too crazy on the home office and so on and so forth. But it is super important to consider the things that can be written off as deductions and write them off. We've got this idea here of W-2 versus 1099. When you're a W-2 employee, unfortunately, there's literally zero write-off options for you if that's your only source of income. Okay, you're stuck. There used to be a method of deducting some unreimbursed employee expenses, but that's gone. So there's this idea of doing a side hustle, right? Side gig, doing some 1099 work, legal cases, or whatever that might be. And when you've got that 1099 income on the side, you're actually able to, write off all those things that, you wouldn't otherwise be able to write off, continuing education courses, licensing, your fancy car. I'm just kidding. I'm kind of kidding, not kidding. Let's not get too crazy. But anyway, yeah, this allows you to be able to write things off. And we could probably have an hour-long conversation on this concept, because one thing that often comes up is this idea of incorporating. Again, that's kind of a whole separate topic. And so I would tell you that even as a side gig, incorporating could be an option, but in many cases it's not ideal. Kind of the ideal is to have the real ideal is to have. I've got one oral surgeon who gets a very nice W-2 from the clinic she works at, and she also has her own private practice where she has self-employed earnings. And this is a great situation, because her employer, where she gets a W-2, is covering and picking up half of her Social Security, Medicare, and all these kind of employment taxes. But then she's got this other nice pot of income where she's really able to deduct a lot of expenses, because there's a lot of income there. So anyway, and with her, interestingly, we did not incorporate, even though that private practice is pretty decent size. Everybody's situation is a little bit different. And so it's super important to consult your tax person on whether that makes sense or not. Because most people would say, oh my gosh, you've got a practice, you need to incorporate. Well, in her situation, it didn't really make sense from a tax perspective. Anyhow,
how about Dave? Yeah. How about LLC? Because, for example, I work as a 1099 for my side gigs. Mm-hmm. I made an LLC so that I can write off a lot of my expenses to complement that when I was working as a W-2. Mm-hmm. How does it? And by the way, it's a question for the audience. We're gonna do Q&As after the slides, but this one was just too good a question. Someone said, can you do a 1099? Do you need to do an LLC to be effective?
So you do not. In fact, when you set up a 1099, there's two things to consider here. First of all, you can't practice medicine with a 1099. So if your side gig has anything to do with actually practicing medicine, it shouldn't be in a 1099 anyway. But if it's some sort of consulting type of a thing, then that's fine. Another thing to consider is if you're the only owner of your LLC, that's considered a single member LLC, which is a disregarded entity for federal tax purposes. So when you go to file your tax return, if you've set up an LLC to kind of run this 1099 income through, from a tax perspective, it actually looks the exact same as if you did or did not have an LLC. Okay. Now, you can set up an LLC and elect to tax it as an S corporation, but that's this whole other discussion again of really it comes down to how big is your W-2 and how much 1099 income are you earning on the side, and how much expenses are you considering writing off? How much in expenses? So there's a few pieces of this puzzle, but yeah, it can be super powerful to have that 1099 income set up for various reasons, right? Additional retirement plan contribution possibilities and so forth. So anyway, the LLC, not necessary, but if there are other people involved, it could be good just to limit, liability, perhaps. Obviously, we all know that, as a physician, malpractice follows the physician. It doesn't really matter what kind of an entity you're built up in. But when there are others involved, that could be something where, it gives you a little bit of protection. I'm not a lawyer. I don't know if that answered your question, Jorge, hopefully.
No, you did.
Well, let's transition to talking about some of these lesser known or untapped tax and wealth strategies for doctors. And I'm going to kick it off with this concept that's referred to as custom indexing. So as I had referenced these different pools of money, you got your retirement account, Roth accounts, and your investment and brokerage accounts. It's taxable money. There's ways as you begin to build that wealth to make that as in a very tax efficient way as well. Custom indexing is one of the fastest growing types of investment strategies that are out there compared to funds and ETFs. The growth rate that's projected as far as this particular amount of new dollars going in is actually really high, but you may not have heard of it. Mutual funds and exchange traded funds are pooled vehicles. That means you can track an index, let's say like the S&P 500, but because they're pooled vehicles, it's like these underlying assets are held away in a safe. You can't really, as the investor, get access to those. But what custom indexing does is allows you to kind of open up that safe by owning the individual constituents of an index, and then be able to do some really creative things, such as tax loss harvesting. On this next slide, it shows the fact that looking over a period of time, just think of each of these vertical bars as a year. Anything that's in the lighter green represents the losses that are a part of an index. The green dots represent what did the index do overall for that year. And you can see in most years, and this is representative, about 70% of the time, the US market is going to post a positive return for the year. But what may not be as much known is that those individual constituents inside funds and ETFs are locked away. If you unbundle that and have access to those, you can begin to take advantage of the fact that a number of securities in those indices trade at losses during the year. And by having a systematic automated process, you can go in and be able to harvest those losses. And what that does is you have the ability then to offset those gains. Those gains could be even in the future. They don't have to be this particular year, but it's a powerful way to make sure you keep more of those dollars that you're earning from your investment portfolio. Moving on to a bit more of an advanced concept. It's a strategy that we're deploying, but it's more for specific use cases. This is called accelerated tax loss harvesting. It's using what's known as a long-short extension or portfolios. Maybe more so than getting into the mechanics of how this works, I think what I wanted to highlight are what are the use cases where this kind of strategy may make sense. So think of if you happen to be a practice owner and you are in the process of selling your practice, you're going to have likely a large capital gain from that transaction. By applying this kind of strategy, you would have the opportunity to see a lot of those taxes minimized, because you can offset those gains with an accelerated tax loss strategy like this. Another use case might be, we've run across doctors that, for whatever reason, have invested in a single security or a couple securities, and those have gone really, really well. And so what that means is, if you were to diversify your portfolio, again, to take some of that concentration risk off, you would incur a lot of capital gains in that process to do this. And by being able to take a strategy that says, okay, I'd really like to diversify out of Apple or Google, or pick whatever stock it happens to be, this is a strategy that enables you to do this in a very tax efficient way. So again, there's some technicalities that we won't get into on this call, but just know there's a lot of different tools that a wealth manager and tax planner such as Earned can apply for doctors that have unique situations where gains need to be minimized as much as possible. Dave, I'll hand this one to you. Strategy 8, the backdoor Roth.
Sure. Yeah. And real quick on that last one thing that I love about the tax loss harvesting strategy and building up this bank of losses is it feels like it's going to give you options as events come up in your life, right? We've got physicians who own surgery centers, who are selling those interests in the surgery centers. Maybe you've got a little rental property or real estate and you decide you want to sell it, and you don't feel like doing a 1031 exchange, right? By having this bank of losses built up, when these events come up in your life, it's a lot less stressful to think of, receiving this cash or selling this property or whatever without having to consider losing, 35% of that to taxes. So anyway, I love that strategy. It's awesome. Okay, backdoor Roth IRA. You've probably all heard of this. Everybody loves this. How can I do this? What's happening? Backdoor Roth IRA is really great. As you know, we are all, we all have too high of income to put money directly into a Roth IRA. That's just how it is. That's the rule. But this backdoor Roth loophole allows us to put money and these contributions directly into a traditional IRA, which gives us what they call non-deductible basis. Okay, so say you put $7,000 in a traditional IRA, and then give it a couple days to marinate, and you convert that into a Roth IRA. Now you've got that $7,000 sitting in a Roth IRA, and that's going to grow tax-free forever. Okay, very powerful, great for wealth transition to the next generation, etc. Now, you might say $7,000 doesn't feel like that much, and that's true, but both you and your spouse or partner can both maximize that $7,000 each year. So that's $14,000 a year. And if you're doing this, for your whole career, that adds up. That adds up, and it becomes very powerful, and it feels good when you remember that slide Bill talked about a few minutes ago where he was looking at the different pieces, taxable money, tax deferred money, and tax-free money. This is our tax-free money piece that we're talking about. And there's really only two ways to get that in there. It's through this backdoor Roth method. And by the way, some of you, again, remember I mentioned talking to your HR department to see what your benefits are. Some of you might have access to what's called a mega backdoor Roth. And what that is that allows you to put a much bigger chunk into an IRA through your employer, up to like $60,000+ into that IRA with basis, which you can then convert over into a Roth IRA. So that obviously you can see is super powerful if you're lucky enough to have that as part of your employer's retirement plan. Absolutely look into that and see if that's something that you can take advantage of. And then the other way is through just typical Roth conversions. Now, I had a client ask me, a younger client ask me just yesterday as we're kind of talking through some of these things. She said, or she asked, what do you see? How do you see this playing out in your clients' lives? And I said, well, my favorite thing to see is to see a client who has saved after-tax dollars, right? So that's you maximize your employer retirement plan. Okay, that's part A. Part B, you're putting Roth money away if that's available to you, and these little pieces we talked about are available to everybody, the basic backdoor Roth IRA. Part C is saving money in just a brokerage account, just savings after you've maximized those other methods. And by building up this after-tax money, taxable money, I'm sorry, you're able to, and again, this is where we get to the optimal situation. A doctor reaches, let's just say 65, because that's the age everybody likes to throw out there. Optimally, a doctor's ready to retire at 60, 62, whatever. And hey, I have plenty of doctors. I have a dentist who just sold his practice at age 80 because he loved what he was doing. And that's fine too, right? There's all different situations. But you retire at age, say, 65. You're not required to take money out of your retirement plans until you reach age 73. Okay, so you've got this 8-year window, okay, where you're not working, your income is probably pretty low, and therefore your tax brackets are probably pretty low. By the way, Jorge mentioned a 35% tax bracket. Well, don't we wish we could all be Jorge and live in Florida where there's no state income tax, right? I'm out here in California, so you're looking at 35% plus 9, 10, 11% state tax. So, we're talking closer to 50% in some situations. So anyway, you have this time period between retirement and 73 where you can do these Roth conversions at a very low tax rate, which is awesome, super powerful. So anyway, that's what I like to see. Backdoor Roth, don't overlook it because it feels like a small contribution, and talk about ways that you can maximize those Roth contributions over your lifetime.
Thanks, Dave. Yeah, and I would just say, as we develop financial plans using these strategies in place, it's very powerful to see the impact of this over, let's say, the life of one's career. Even if there's just 5 years, and as David referenced with the conversion strategy, maybe you're already in retirement, not yet to that point where you're receiving RMDs. Like, this is a strategy that can be deployed throughout one's career and even into early stages of retirement that have meaningful impact, going back to the amount of dollars and the flexibility that creates. So I concur, Dave. Don't ignore this particular strategy. Number 9, it's another one, again, that may not be top of mind, but we think it's really important, of the integration between tax and how you manage your assets and investments. This is a concept known as smart asset location. You may have heard of asset allocation. That's where you have a diversified portfolio across stocks and bonds and real estate and other types of assets. Smart asset location is the concept of saying, okay, we have all these different categories of investments. What's the smartest, tax smart way to place those assets in these different types of accounts that we've been talking about? Tax deferred, tax free, and taxable assets. And it may think, well, what does that matter? Well, one example is, as you look at the less tax efficient types of vehicles on the right-hand side, things such as REITs and taxable bonds that are being taxed not at lower capital gains rates, but at higher income rates, that then if these are held in taxable accounts, you're not getting the same benefit if these are placed in more tax efficient account types. So this strategy is one that just uses the benefits of, let's say, the tax code, these types of different account structures, and then placing these in the most tax efficient way. We've run some analysis, but in addition to what we've seen, there's been academic research that suggests anywhere, 50 basis points, 0.5 percentage points per year, compounded over time, if this strategy is put into place, can create, again, another way to excel and accelerate your long-term wealth creation. On number 10, so we've talked about all this different ways of bucketing money into tax-free, tax-deferred, taxable accounts. We've talked about Roth conversion, backdoor Roths. Now you're at the point where you need to start drawing some income. And doing this in a tax smart way is another important step to do this. And I'd say what you see on the right-hand side is maybe a common way to approach this. Let's take money out of taxable accounts first, then go to tax deferred and tax free. It may not be as simple as this. Depending on your circumstances, maybe doing some things pro rata makes sense. Maybe if you have the opportunity for excess wealth at the end of your life, really deferring and pushing those growth oriented assets and those Roths makes a lot of sense. And let's not tap that. Let's let that grow and compound. There's some benefits even from an estate planning perspective. So just because you've done all this wealth building in a tax smart way, don't turn off that tax smart component once you hit the retirement income phase. This is, I think, the important component that I just wanted to highlight. And as we move now, Dave, I'm going to hand this to you. We've talked about a lot of different strategies. In some ways, we just kind of scratched the surface. Talk to us a little bit about what's on this slide.
Absolutely. No, this is, I like this. I like the visual here. I'm at first I thought maybe this should have gone downward sloping, you miss some of these things and it's like a slippery slope. All of a sudden you get yourself into trouble and you end up at the end without a plan. And here you are at, retirement age and you haven't set yourself up to be able to retire. It's a little bit of a slippery slope. Slippery slope could also represent being too aggressive with tax planning and so forth. I envision this as a big banana peel. Slip on that thing and you could get yourself in a whole lot of trouble. Anyway, yeah, there's too much on this slide to digest. As Bill mentioned, we really just scratched the surface. I mean, we touched on 10 things that are kind of big picture ideas. There's a lot of interesting stuff in here. Just kind of starting up there at the top, estate planning. I mean, please, all of you should have an estate planning attorney, or at least somebody that you've spoken with to talk about setting up, a trust, a living trust, and a will, just so you've got your things in order, right? That's super important, and that helps you. That is a pretty important part of the big picture, especially as you get into accumulating quite a bit of wealth. That can become super important as a part of your whole financial plan. 1035 exchange. We didn't really talk about insurance here, but a very big part of a lot of people's financial plan is that insurance. And what a 1035 exchange is basically if you've invested in some life insurance plan or other, and you didn't get the best advice, or the plan had fees in it that were hidden that are not ideal or whatever, you can actually do an exchange where you take what you've invested and roll it over into a different policy that's more beneficial to you. So anyway, that's a pretty powerful thing that you can do in terms of big picture planning. Just make sure that you're getting the optimal benefit out of all those types of things, including life insurance and stuff.
Dave, I'm sorry
yeah.
to interrupt. I see one that I think about many docs on this call. We talked about W-2 employee, but talk about this HSA and FSA for a minute. That might be one worth kind of calling out on this slide too.
Sure. Yeah. So HSA and FSA, health savings account, flexible spending arrangement. These are plans where a health savings account, you're able to, it feels like an IRA almost, right? You're able to put money into this account. It's more like it's the best of both worlds. It's like an IRA because you get a tax deduction for putting $7,000-8,000 in this account, and then as you spend it, it's tax free forever as long as you spend it on the right stuff. So actually, pretty powerful. You have to have a qualifying health plan to be able to do that, which means a high deductible health plan, which interestingly often leads to lower premiums and so forth. Of course, a lot of you are probably have those premiums covered by your employer anyway. But the ability to put this away and invest it, you can use it whenever, right? Like maybe you use it in retirement when you start to need more healthcare, and now you've got this nice little pile of money that you can use for that. FSA, that's something, again, you arrange through your employer. And this is what I was talking about, if you go talk to your tax person in November and they say, oh, are you maximizing your flexible spending account? That's where they reduce your salary. They take it right out of your earnings and put it in an account that you can use to reimburse health expenses. If you start talking about that in October, November, December, you might have to go without a couple paychecks in order to be able to fund that all the way. So anyway, those are, again, there's so many pieces that feel small by themselves, but when you add them up, like I said, that $25,000 a year that Bill threw out earlier, gosh, that's easy to realize that. I think the last thing I'll point out here that I think is pretty impactful is I see a couple things here about charitable funding. There's a lot of different ways to make charitable contributions. And for a lot of us, we talk about, well, how can I save taxes? I couldn't tell you how many clients I finalize their tax return, I send it off to them, and they say, what else could I do? And I say, well, I mean, honestly, it's all done, right? Here we are in March or whatever, last year's done. And one of the biggest things that I say, now, are you sure that you factored in all of your charitable giving? Because yeah, you can write checks to charitable organizations. Sure. You can put money into donor advised funds, which is powerful. And we'll talk about that. But there's strategies around this, right? Lumping donations so that you get the bigger tax effect in one year and then take the standard deduction the next year, right? Like if you're a client who, let's say your mortgage is paid off, Jorge's is probably paid off. No, I'm just kidding. Lucky you if your mortgage is paid off, right? But if you don't have a mortgage interest deduction, your state and property tax deduction is limited to $10,000. If you don't have any charitable giving, you're most likely not even itemizing your deductions. And so in that case, charitable donations don't even do any good for you from a tax perspective. But if you're like a lot of us these days, you've got a nice little mortgage interest deduction. And so those charitable contributions really make a difference. I'm sure a lot of you are involved or would like to be involved in, one of these Doctors Without Borders, or, going on mission trips or whatever to provide that type of care. What an awesome way to not only, give back to people that definitely need your help, but hey, that whole trip to Africa, it's all a tax deduction, right? So, think about things like that. Gosh, I'm getting excited here because this is kind of a fun part, right? Like, taxes, investing, give me a break. That's no fun. I want to talk about like living, right? Like getting out there, doing this type of work. I mean, that's what is going to be more fulfilling in your life at the end of the day than chiseling out little tax savings here and there, right? Like do things that are going to be impactful and meaningful for you, and we'll figure out a way to make those tax beneficial as well.
Yeah, Dave, I think that's a great point. And Jorge, go back to you. But my quick take on this is, for this audience in particular, the FIRE audience, it's all about financial independence and making smart choices here, finding the ways to fully maximize the opportunities that are in front of you, just creates and opens up so many more opportunities, Dave, as you were saying, to do the things that you love. Anyway, George, Jorge, I'm sorry, you mentioned probably something you wanted to add to.
No, I wanted to speak to one thing, which is one of them is like, that's a tax smart strategy, is your salary. Because 80% of American doctors are employed by some kind of hospital or ambulatory. Very few are independent, but for a salary, when you're getting into a new market or you're negotiating, like spend an extra effort to negotiate even $10,000, $15,000, because that difference that you have over years is multiplicative. If you invest that difference into assets, you have far-reaching parts. And this is something that as physicians, we tend to follow the crowd and not to negotiate for our own value, which is really challenging, right? Because we put so much time into our education. We busted our butts in residency and internship and all that. So one of the things I'm very, very focused on is negotiate a reasonable salary. Don't follow the crowd. Value yourself, sell yourself, and just take that extra time. Take one extra meeting in the hiring process, because your salary is fixed for a couple of years, right? So that's important.
And I'm sure Jorge would speak to this, and a lot of you can as well. These last several years have been very challenging. And I have a lot of clients who say, you know what, I was thinking about retiring a little bit later, but I'm done, right? So what that does is that does put a lot of you in a position to be able to, like Jorge said, say, hey, I'm working more hours, I'm covering more shifts, I really need to be taken care of. So anyway, that's powerful, Jorge. Thank you for that.
Well, I'm going to wrap this portion of the webinar up with one more slide that's pretty similar to what we started with, of just saying the compounding benefit of tax smart strategies when you then take those savings and put them to work. So this is just showing, again, another way over 10, 20, and 30 years, just from almost like the wealth management portion of this. If you were to not do tax smart investing, tax smart wealth management, you're leaving a ton of money on the table that's unnecessarily. And in this case, starting with $1 million, compounded growth over time, a tax smart approach can generate more than $3 million over a career. So you think about this and these numbers that we've talked about, I think the impact behind this, yes, it's great to have more of that net worth available. I think of what this chart is really telling is a story that gives you flexibility and independence. And it's at the heart of what we do, and having that opportunity to kind of unlock those potential for you as a doctor. It's such a smart thing to kind of deploy what we've talked about. So we'd love to get a chance, Dave and I and the rest of our team, to be able to do a free tax consult and see if there's ways that we can help preserve more of your hard-earned wealth. In just a minute, we'll give you a QR code at the end when it's questions that you can go and book that meeting. But would really encourage you to do that. Earned Wealth specializes in both tax and wealth management, over 3,000 clients, many who are doctors, that we're working with, and really helping them unlock the value that they have as high income earning professionals. And one final note too, Earned, we're a fiduciary. It just simply means we have your best interest at heart. And as you're looking at other advisory firms, tax planning, wealth managers, make sure they fall into that bucket as being a fiduciary. Jorge, I know there's some exciting things that you wanted to share in partnership that we're doing. Speak to this slide for us.
Yeah, so one of the things as physicians, we tend to be very data driven. Like, we manage our patients in intensive care units, we manage vitals, we look at labs. And when a situation is complex, at a drop of a dime, we will consult for the health of our patients. But it's interesting that we don't consult for the health of our finance. So that's why I really believe in advisors helping us to the journey to FIRE. But one of the things about the data management is that if you can't measure it, you can't manage it. And this app that we've worked with Earned to develop is a cool app. It just helps you know where your money is going. It sets you to set up variables where you can track your money, and you can monitor your monthly subscriptions and just find out where you're losing money from. So I see this as a CFO in your pocket, so that you can just open it up. You can download it if you scan this QR code, put it on your phone, connect to your accounts. I look at it and I catch stuff all the time and save myself money. So check it out. It's free, no charge for it. And we've put a lot of time in conversations with the engineers over at Earned to get this done.
Yeah, would encourage everyone on this call, take a snapshot of this QR code, download this. It's a complimentary, kind of our gift back to you. We believe just taking that first step that I started with, being smart about planning. this is one of those steps that kind of aligns with that, and would encourage you to do that. I know we're getting close to the top of the hour, but time for a few questions. Before doing that, this QR code, different than the one we just showed. This QR code will take you to a landing page where you can sign up for one of those free tax consults, and just encourage everyone on this call to take advantage of this. An opportunity just to share circumstances, explore with a professional if there's ways to actually keep more of your hard-earned dollars. We'd love to get a chance to meet you. And with that, Jorge, hopefully there's some questions that have been queued up, and Dave and I are glad to take a stab at them.
Yeah, so one of them is, let's see, there was a lot of questions on 1099. One is Dr. Anonymous. Can you briefly review what type of business expenses you can use to create an LLC that is justified and legal? A lot of MDs buy real estate as investment. What expenses are related to travel to the state where your property is sitting?
So I'll address that. 1099 income, I basically say that anything that you have to pay in order to be able to provide that service. So for example, if you're getting paid a 1099 because you're a physician, then you've probably got some licensing, some education courses, some different things like that, your phone, different things that you need to have available to be able to earn that 1099 income. So that's kind of the easy litmus test, right? Like, is it something I would need to have in order to earn this 1099 income? You probably don't need a boat to earn that 1099 income, unfortunately. And then, home office, Jorge mentioned that. I'm a really big fan of kind of reimbursing yourself for use of home office space. There's a whole form on the IRS tax returns that you can do where people always ask me, Dave, is this a red flag? Is that a red flag? I'll tell you, using the IRS's form to claim the home office deduction is probably one of the bigger red flags, if there really are any. I always tell people, I say, there's no real red flags. Well, home office kind of is one of those, because like Jorge said, very rarely do people actually have full designated space in their house. So what I typically do is I would just do an expense line that says, office administrative expense or whatever, and just take a portion of, some of those expenses from your home and just, write them off in a line called office admin expense or something like that. It gives you that tax benefit, and you can sleep at night because you say, hey, you know what? I really do use my home for this work, but it's not kind of painting a big red target on you like, hey, I'm doing this home office deduction, right? And then as to the rental property question, again, what costs are necessary for you to go check in on your real estate? If that rental is something that, is a vacation rental, and when you go to check on it twice a year, that's actually just when you're going to use it for your private days, I don't think I would go, I would write that out. That's probably more of a vacation. But if you really do own a rental property somewhere and you legitimately are going there to check in on it, do some repairs and do whatever, sure, that whole trip is obviously deductible. Now, I'll let you determine whether that was a tax deductible trip. You know what I mean? Like, I get a lot of questions sometimes from clients where what they're really asking is, Dave, will you allow me to take this deduction, even though I know it's not really a legitimate tax deduction? You know what I mean? Like, they know it wasn't really necessary, but will you let me write it off? And so a lot of times I like to kick that back to them and say, hey, look, this is your tax return. If you're telling me it was legitimate related business expense, sure, I'll put it on here. I'm fine with that, but don't cry to me if you do get in trouble, right? So anyway, it's legitimate expenses are deductible.
Got it. I think we're running out of time. So thanks for attending. One of the things is We Earned is a sponsor for our first Prosperity Conference next year in March. So if you want to come over and learn about entrepreneurship, financing, being a high income earner, and just improving your game, come to the conference. The other thing is, like, why was this webinar important to me? I think the important thing is that when you reduce your tax burden, you get to keep more of your hard-earned money that you just busted your butt to make. And if you take those investments and those earnings and you invest them in assets, then you'll make more money, which accelerates your wealth. And you just make this flywheel that it just adds to your wealth, which helps you reach FIRE sooner. And that's the key thing about this, is not to lose money, make as much money as you can, and just mitigate it's called tax mitigation for a reason. So with that, we'll let you go. Look out for an email from Earned that has a link to the webinar. Earned is a partner of ours. We have a lot of fascinating, interesting webinars that we do with them. And again, thank you for your time, and we'll see you guys soon. You have a great day. Thanks for stopping by.
Thank you.
Thanks, Jorge.